primary market in that sense is the UK. And this initiative is obviously born of that engagement. We also looked at Singapore, because we know that there's a very close relationship between our central bank and the Monetary Authority of Singapore. And we also looked at the UAE, sort of focusing on what incentives are sort of provided through the DIFC, and what we could borrow from that. Then we also looked at a number of other markets on the continent and externally, but for more specific ideas that we potentially could get, and then seeing, whether we think that they have done something that is worth considering for our market. So this is really just sort of presenting again that tabular format. Kenya's position as against the category 1 countries. Sectional 2 are the main regulators. In the UK, FinTech is largely regulated through the FCA, the Financial Conduct Authority, and the Prudential Regulatory Authority also has some mandate. Singapore, it's really the super regulator, the Monetary Authority of Singapore. UAE, there are a number of regulators depending on which emirate you're speaking of. We had some, there's quite a bit of work that's been done by Abu Dhabi as well as Dubai, and so some of those regulators are highlighted there. Again, it was worth noting that you don't have any blanket or overarching regulation in any of these markets around fintech. So Kenya is not alone in that regard. We also looked at, what are some of the things that governments have done, to try and encourage the fintech space to develop. And so looking at Kenya, some of the good things that we were able to highlight was the introduction of sandboxes. The CMA and IRA have sandboxes, and you do have fintechs that are currently being developed through those sandboxes. There is also the general approach that the central bank has used in terms of understanding fintech and also creating forums for fintech conversations to happen, like the fintech Afro-Asia FinTech Festival. There is collaboration between our regulators through a joint financial services forum between the various financial service regulators in Kenya. Equivalent sort of initiatives in other markets, FCA's regulatory sandbox in the UK, together with a fintech hub that has been established by the Bank of England. We have a fintech office in Singapore, together with innovation groups and of course the festivals, which is what we borrowed from. And then similar sort of initiatives in the UAE. Now, in the interest of time, I haven't gone into what did we borrow from some of the other smaller markets. A lot of that detail you'll find in the report. And I would just urge you to take time to read through that report and see what some of those issues were. So besides sort of looking at the literature and the regulatory provisions, we also had now interviews, face-to-face interviews or virtual interviews with stakeholders. And so some of the issues we were able to sort of identify as challenges that they face from a policy and regulatory point of view is uncertainty and overlap between regulator mandates. So again, going to that point around, if I've got a product that potentially touches on a number of regulators, then who do I go to? And part of that then leads to the other problem around sometimes not getting your products or services approved fast enough. And so again, that concern around slow lead times for approvals as well as licensing. It's a good thing that some of the regulators have set up sandboxes to allow for testing, but it was felt that more could be done, especially for the fintech providers that are regulated, say, under the central bank. And so one of the main things that kept coming out of that is, could we at least have maybe a single sandbox that all of the regulators sort of contribute into, and that will now facilitate that process. And then again, some concern around too much focus on risk without necessarily appreciating the value of the innovations. So again, these are not PwC views; these are views expressed by stakeholders. So I think it's just important to make that point. talked about the fact that we don't have a fintech policy, but there was a sentiment that we need something that just tells us where is the government taking us, and is it clear, and we all know what to expect. There's also issues around incentives, and those sort of incentives also would facilitate even funding of the fintechs. Issues around, can you create some sort of preferential tax regime to encourage investment in fintech? We've seen that in some other markets. Singapore, stood out as a case in point. And then for those fintechs that do want to scale up, or fintechs that maybe are coming in from new markets, a suggestion that perhaps there should be some engagement between regulators in different countries, so as to facilitate the process of establishing in new markets. And to the extent that there were similar approaches, how can that be facilitated so that it makes it easier to scale? Obviously, once you identify the challenges, then you had some proposed solutions. Again, talked about, can we have a national fintech policy that gives guidance, clear guidance to the sector? What can be done amongst the regulators, perhaps capacity building, and sort of more close discussions around how do the innovations work, and hopefully that then will take care of the problem around slow lead times for approvals and licensing. I request that perhaps you could have a one-stop shop, and this is a potential role, for example, the NIFC can facilitate. Again, meaning that you don't have to keep hopping from one regulator to another to have your conversations. And that ties into the idea of having a blended fintech sandbox. Also, create a partnership framework between innovators as well as, and I think this was touched on in the earlier session around how to create partnerships. And it also goes to the point around closer conversation and collaboration between the regulators and the fintech community, so that some of these issues are ironed out, and it's more of a collaborative working relationship that exists. There was a call for government incentives, and I think the work stream that was considering around funding probably will touch on that. And then formal forums for information sharing. This is great, what we're having now. And we've also been seeing a number of, I think last week, Safaricom had a FinTech Forum. So more and more of that kind of engagement, so that stakeholders also feel that their views are being aired and something's actually been done and they are part of the process. And then the issue around cross-border collaboration, how can government kind of step in to also facilitate that sort of engagement to allow scaling up? So we then distill this into a number of recommendations, trying to see, okay, what do we think can be done within, within 2 years? What might take longer, and what is potentially a long-term solution? So we felt that in the shorter term, it's really trying to just create some organization around how fintech is discussed. And so, the establishment of the one-stop shop, for example, and perhaps facilitated both by the joint forum of regulators together with NIFCA. The idea of the consolidated sandbox, I think, could be something that could be done within 2 years. The strengthening of cross-sectoral collaboration, and again, that can be facilitated by the regulatory forum as well as NIFCA, and capacity building. And it goes to that larger question around what can the UK do to help that regulatory environment, and maybe that's the idea around capacity building, resourcing these regulators with the knowledge and the expertise to evaluate these innovations when they get brought before them for approval. In the longer term, perhaps now start talking about, we create an actual statutory framework that perhaps can help sort of manage the fintech sector as such. And then we can think about the tax incentives. Those are not easy to get in Kenya. The Treasury doesn't really sort of there's always a bit of a challenge around trying to get tax incentives because it's just seen as a revenue leakage. But we feel it's an asset center, an asset sector, and therefore that can really help the sector grow. And then, we've got some long-term ideas. That we think that the ideas around mutual passporting and allowing, fintechs to scale into new countries, that's probably something that will need to be negotiated government to government. And it's probably not something that can be achieved within the shorter term. It's probably something that would require sustained engagements between governments for that to be achieved. So that's the report in a nutshell. And I guess we could just move on to panel session and take questions. Rosemary?
Yes, karibu sana. Welcome. I think we can take the panel session from this side. So maybe on to the first question. This one goes to Elias. Hi, Elias.
Hi.
So you've had experience with a Sandbox, especially in the insurance sector. What learnings can you share in terms of us trying to get something similar in the financial services market?
Right. It's always difficult to kind of become a pioneer, particularly when you are creating a test and learn environment on a sector that at times people are not really close to. And ideally, so many communities and businesses are exposed to risk. And one of the key things that this particular Sandbox or a test and learn component really wanted to achieve was in terms of increasing inclusion. So it was quite a themed, I would say, approach towards increasing inclusion within the region. And the reason why then the regulator thought that it was important to provide a platform for these particular persons that were interested to create a change within the ecosystem was that can we kind of develop a tool or a policy that will invite and harness the innovations at the same time address what most of the time we call regulatory I would say lack of clarity in the regulations. Most of the time regulations do not lack. But the challenge is that do these insurtechs or fintechs, do they understand what these particular regulations entail? And ideally, that particular close collaboration with the insurtechs kind of enable these particular institutions to quite see what was there in the regulations and kind of see how then do we apply those particular regulations. So the most difficult part is application, and lack of proper application comes from lack of understanding or lack of regulatory clarity. So within that particular platform, which we call BIMAbox, kind of provided that an avenue whereby the regulator became close to these innovators, and in that they provided some form of regulatory clarity on a couple of issues. At the same time, enabled the regulator to learn on what needed to be changed, because at times there is need to learn from what the innovators are looking into, or maybe the changes that they might want to see in the future. So ideally, it was a very symbiotic relationship between the innovator and the regulator. So the learning was that the regulator was learning on one end to see how then they could change certain laws and applications of certain principles. At the same time, these particular insurtechs were also quite learning the issues around clarity. Maybe something quite important that I need to mention was the issue around circumvention of the law, because when we talk about the sandboxes or the test and learn approaches, the regulators are quite keen to ensure that institutions do not circumvent the law. They need to look at what we call legal diligence. The company also has to do some form of legal diligence. Do we really need to be exempted from certain aspects of the law? Are we capable of doing this without these particular exemptions? Because if you allow a circumstance whereby there will be what we call circumvention of the law, then it kind of creates regulatory arbitrages within the entire financial system. So that is something that we learned, that there was need to quite do some legal diligence on who was coming through the door, just to ensure that there was proper issues around areas that would lead to regulatory arbitrage. Thank you.
Thanks so much, Elias. And I guess for the regulators listening in, some points to be taken. Next goes to Craig. Craig, I'm going to ask you two questions. The first one is, are we alone in this? In terms of this market looking for regulatory frameworks that are, more friendly? And the second question is going to be on fintech scales pretty fast. And most of the time, there's a need for, like Joseph has mentioned, cross-border interaction, say transporting and even things, innovations like cloud. What are your thoughts on that in terms of helping to scale fintech from a regulatory perspective?
It's a good question. First thing, I'll just say what a delight it is to be here. It's been, I'm going to get quite emotional now probably, and Elias is going to kick me. But it's been a long journey for us, I think, in coming to today and all the work that everyone has put together. PwC team, all the guys at TheCityUK, Oscar, Jadida, Elias, myself. There's been a lot of people behind the scenes. So first, just to say it's a pleasure, and having grown up here, it's a real treat to be back here and help to contribute to something which I think is going to be a key part of the future growth of Kenya over the coming years. So back to your question, and sorry for the divergence. Are we alone? Are we ready in this jurisdiction? I think a lesson learned from other markets, and Joe's done a great job of sort of outlining the comparators and benchmarks we've used in other jurisdictions, is that, there's been such a pace of change across the world, and, you can take any one of those from, any insurtech or regtech or new sort of digital banking solution. Crypto is a very good example. The very few regulators in any market were quite ready for what was coming. So they've themselves had to learn as they've gone along. I mean, there's been lots of sort of engagement between regulators and industry groups and organizations bringing these new products to market to understand what it means, how it fits within the existing regulatory perimeter, the legacy structures we have, and recognizing, well, how do those existing frameworks, regulatory requirements, policy standards, how do they apply to these new products coming through, new business models? How do we regulate them? How do we ensure that there's stability in the market? How do we ensure we look after the interests of deposit holders, consumers? How do we ensure the stability of financial markets more broadly put? And we look at a lot of lessons we learned through the financial crisis around that. And that's where a lot of the sort of the regs that I deal with on a day-to-day basis have come from, frankly. So I think it's always going to be an ongoing process. I think I had various discussions over lunch with people saying, well, how do we make the change? And Joe put up some short, medium, and long-term sort of priorities. And I think that's absolutely right. We need to focus on some easy wins, understand what we can do now, how we can create for example, the regulatory sandbox. I mean, the sandbox is not the solution to everything. I hate to say, Elias, but it is a way of helping new entrants come into the market. How can you test new business models in a safe environment? But beyond that, when you're going out to launch a product to market for the first time, taking on real customers, how do you do that in a way that ensures that you're not going to trip up, you're not going to cause issues? You yourselves have your own, as an organization, as a new entrant, have your own infrastructure stability, certainty down the supply chain, understanding of your own market, and frankly, capacity within your own teams and experience with your own teams to do that. Because a lot of people coming through with shorts and flip-flops, and that the conversation was made earlier, a lot of people don't understand the regulatory environment they operate within. So there's a little bit of a learning curve for them too. And then the point around sort of scaling and cross-border, I think it's certainly a lot easier now. We probably wouldn't be having this discussion 10 years ago because it wasn't as easy to build a business almost overnight. So the benefit of cloud, SaaS solutions, new technology solutions means you can grow and scale a business very, very quickly. Now, there's pros and cons to that. It means you can grow a business very quickly without necessarily always having done the diligence, to Elias's point. But at the same time, it means that you can get a product to market really quickly without huge capital investments. You haven't got to go and buy a load of servers and put them on the floor and spin them up. And you can buy sort of code snippets and you can buy in products. So I was talking to Stephen earlier about, fraud, AML, credit monitoring tools that you can actually buy in off the shelf. So you can focus on your core business model, and I'm going to buy that in. And these are recognized solutions that work. And I can focus then on doing that. And the cloud enables, organizations to do that much, much more quickly. And, it's an OPEX rather than a CAPEX spend. So there's ability to do that is hugely important. And then to scale that business and to operate cross-border, the challenge around that, and it's probably not on the agenda, but just to make the point, is the data sovereignty issue is an ongoing challenge. So how do you operate in multiple markets where local regulators are saying you need to hold, store, house, secure all your data locally? So how do you, as a Kenyan business growing out and trying to look into Uganda, Tanzania, Rwanda, Ghana, wherever, how do you do that? You've got to then set up separate instances in each place, which means your cost increases, possibly risk increase, and your ability to draw down on AI tools and some blockchain solutions are challenged because they're by their nature, often centrally housed. So there's a little bit of challenge there, and I know that's an ongoing discussion, and probably this is an area that I'm sure you're looking at, and other colleagues here be looking at as part of that ongoing dialogue on the data privacy considerations and cross-border data flows and all that. I've probably used up all my time, so I'll stop there and allow you to ask the next question.
Thanks, Greg. I think it's really important because there has to be a connection between the core of technology and the things that we're building, and actually bringing those two together from a regulatory perspective. Next, on to Joseph. Hi, Joseph. So you mentioned that you studied some jurisdictions which you weren't able to put on the slides.
Yeah.
What nuggets of wisdom would you share from those jurisdictions that we could borrow from as we have this effort?
Okay. Pick jurisdictions such as South Africa. So one of the ways they've really encouraged and the fintech sector is conducting a lot of forums and the government actively bringing in stakeholders and having conversations, and those forums then guide the policy that the government adopts with respect to fintech. We've seen other markets such as Rwanda, where you get the main regulator taking the lead in creating the Sandbox, for example. We've constantly also been looking at Rwanda in terms of where it's trying to position itself as a fintech hub, and they've been taking a lot of strides to try and market themselves as a destination. But it's very clear that this is because the government itself has taken the lead in going out there and creating that perception. Now, it may be a different thing as to whether, ultimately how will it work, but nonetheless, you can see that very strong ownership and accountability by government to develop that space. So again, I think that is, going to the whole point around, do we have a national fintech strategy? We could look to a market like Rwanda to see how they're sort of doing that. We've seen similar sort of efforts in Ghana, for example. Again, they've set up a fintech innovation office, and the whole idea is wrap around the various stakeholders, and let's see how we can get the best for Ghana out of the fintech sector. Nigeria is one market where, as much as we didn't see that much in terms of government engagement, nonetheless, the industry itself have taken the initiative and create privately initiated sandboxes. And we've seen what the impact of that has been. Nigeria is probably the destination that gets the largest fintech funding on the continent. And the kind of money they're raising is incredible. So again, industry itself, we can't just say it's for government alone to do all of that, but I think we also need industry itself to take the stake, to also initiate that and push for that. So those are some good ideas to sort of borrow from some of these other countries. Yeah.
Thank you very much, Joseph. And I guess I like the fact that you've thrown back the challenge to industry, and good work, I guess, by Association of FinTechs and everybody else in the room who's coming together to try bring this. So my last question will go to all of you before we open up to the audience. It's on striking the balance. What are your thoughts in terms of consumer protection, market stability, regulation, regulatory practices? What are your thoughts as we seek to achieve a safer and maybe more vibrant space for the fintech market in Kenya?
Right. As an ex-regulator, most of the time you get lonely because the industry wouldn't want to see you most of the time, because you're always a guy or with a stick, and you'll always want to cane. And that's, in essence, ideally where we look at consumer protection. And I think most of the time, from a regulatory perspective, consumer protection becomes one of the most critical components in terms of their mandates. But we've kind of seen some form of evolution, particularly in different sectors, whereby regulators are now talking about market development. And whenever we talk about market development, what comes in your mind is ideally the use of innovation in terms of reaching out to either the unbanked, the underserved, particularly with the financial products. And that kind of have kind of expanded the scope of regulators over the time. And in that, then they have kind of gone ahead to get the right balance, ideally between market development and consumer protection. And within that, then we've seen a couple of regulators now setting up what we call accelerator platforms, regulatory-led accelerator platforms that enables them to kind of look at ways in which they could strike the right balance. Ideally, within those particular platforms, they tend to have a taste of what the customers will be looking at, and ideally also looking at what the innovations will be coming out to solve some of these particular challenges. So it is something that we are still looking at ways in which we could get the right balance, but that has kind of been taken forward by the enhanced regulatory mandates that are coming through, particularly in Africa, whereby there are still a couple of people that needs to be brought across the value chain and ideally being taken through the financial engagement and literacy. At the same time, what will mean to strike the right balance is also collaboration and capacity building, whereby customers also need to be they need to be educated about these particular financial products, the solutions that are coming their way, because without really giving them the right education, the right documents for them to clearly understand what they are signing, it will be quite difficult to strike that balance. So it's across the industry. We need to create that ecosystem whereby the regulator is part of that particular ecosystem to be able to understand what is happening on the market. Because most of the time, we usually, as an ex-regulator, most of the time we were in a tower house, and you could just be watching across and scan the market and you wait for someone to do the wrong thing. And then the next thing, you are pouncing on that particular person and harass them the way you need to harass them, so that the other people should be able to see that if I do this, I will be caned properly. And that's something that needs to change. We need to kind of now get to where these particular persons are, try and learn what they're trying to do, try and see what the customers are talking about, and basically create an ecosystem that will be self-feeding to what the needs are and also to what we really need to streamline within the market. Thank you.
Thank you, ex-regulator, and happy that you've changed your thoughts after interacting with the market. Next, Craig.
So Elias has spoken about consumer protection. So I won't cover that because I think he's done a great job of outlining the challenges there. I think one of the challenges and sort of balances that I'd probably like to sort of raise, I'm sure everyone's aware of this, is the word resilience. So it kind of comes in two forms. The first one is resilience of the fintech business in ensuring that it continues to operate. It's got assets ring-fenced in the right way. It's got the appropriate custody arrangements around those assets or deposits, whatever it's looking after. The appropriate sort of management structure to ensure it can operate in the right way, manage the risks that faces it. The other piece of resilience is looking at sort of technology resilience. And we're talking here primarily around businesses that are founded and built upon technology infrastructure. And one of the real risks that we've seen over years, which can, you can take 10 years to build a business and it can be destroyed almost in a day, is through lack of resilience in infrastructure, lack of resilience in the technology it's built upon and the third parties that you rely upon for that. And I think one of the key pivots as a business comes through the authorization process and becomes, regulated to provide financial services and products, is recognizing there's an increased risk that comes with that. You're not just a startup, you then become a financially regulated business. And, whether it's, your infrastructure is not stable, it can fall over, you haven't got appropriate backup procedures, or it could be a wide-ranging cyber event. And this is the first time I think anyone's mentioned the word cyber in this discussion today. And certainly we've discussed COVID and the challenges around that. We've also discussed the geopolitical issues at the moment. We are certainly seeing at the moment an increased trend in ransomware attacks and cyber attacks more generally. Those can cripple a business overnight. So one thing to be aware of is you've got appropriate resilience in your business to stand up to those technology challenges that face a business. And then for the regulators, to go back to that point, to ensure the regulators are sufficiently aware of the issues, and we've got a right-sized and focused regulatory environment that enables people to be aware of what those standards are they're expected to meet, but also to help them through it. Because I think a lot of organizations won't necessarily understand, well, what does good look like in this space? So it's, I think, helping that dialogue what does good look like when it comes to cyber resilience, technology resilience, and how does that apply also through the supply chain, recognizing you may be reliant on a number of other third parties who haven't necessarily built their solutions for financial services. Now, I won't mention any names, but that's certainly the case. Again, I'll stop there because I'm sure you're keen to ask Joseph the final question.
I'm so sorry, Joseph. You have to give us new points. I hope you haven't
We've got
covered
all the good
everything.
ones.
I know.
Yeah.
It's taken all my talking points. But I think one thing would be all of the regulators have a mandate where they say that they take a risk-based approach to evaluating whether it's licensed applicants and the like. So I think what needs to happen is for that approach itself to be explained, and for people to have more clarity as to how exactly does that work, and also being able to identify where are the core risks, and some of them have been talked about here, whether it's cyber, whether it's data privacy, and then not this, because part of the challenge that the stakeholders were expressing was, you're submitting so many documents and explanations over an extended period of time. So it's not quite clear where the regulator thinks your risk lies. So there's that lack of clarity. And I think the way that can be resolved is also for regulators to publish more guidance around that. This is our approach. This is what we think about this, and make it very clear so that what happens is when stakeholders come in to put in their applications, they've pretty much known what they need to, the information requirements that they need to meet, right? And they have a clear understanding of that. Related to that point is also the fact that because we've had traditional sectors that are regulated, and a lot of the regulations right now sort of talk to the traditional sectors, it's easy for that sort of regulation to be taken and applied to a fintech business model, which is probably not that complex. And so the issue there then becomes, should a digital credit provider be regulated almost as if they are a bank, for example? And we kind of went through this whole conversation when we were assisting the Digital Lending Association with the regulations that have finally come out. And we were able to sort of put forward certain suggestions as to what the regulations should focus on. And therefore, do not treat digital credit providers like they are traditional financial institutions.
Yeah.
They're not that complicated. They lend their own money. They don't borrow from the public.
Yes.
And so let's have tailored legislation that speaks to the business model that these fintech providers operate with. So, I'll stop there, but, those are some of the ideas I think can also be picked up.
Thank you. Thank you so much. I guess it's been a wealth of knowledge. So yeah, the next thing we're going to hand over to the audience. But before I do that, as a policy lawyer earlier on, I used to ask myself, why don't you have handbooks, like the FCA handbook? Like when you're getting started, it's really difficult to know where to go next. And I think you've all spoken to bits and pieces of that, like trying to navigate the regulatory maze. And I hope that's going to be an output out of this. So over to the audience. Any questions? Yes, Muni.
Thank you. Thank you. Very quickly. Thank you just for the presentation. I think quite informative. I think one of the things that I picked up from the presentation is that across the jurisdictions that you looked at, apart from probably Singapore, there's no other jurisdiction that has one entity that is actually looking at the fintech space. And looking at fintech being a nexus of two disciplines, financial services and ICT, as it were, before, and the fact that fintech sits at the core of a couple of industries, agriculture, health, and all this. So the question then for me would be, do we need to look at regulating fintech as an industry? Or do we need to look at actually creating policy guidelines that guide how the fintech industry operates? Because if I give a very good example, and these are just my thoughts. What happened with the digital lending industry, for example? The hue and cry came across because of abusing customer data. That sits under the purview of CA and under the data commissioner, but ended up changing the CBK Act. So in a sense, then you see, the fintech industry sits in between a couple of regulators, yeah? So the question is, how do we handle that? And I mean, it's just, I'm putting it out there. Do we need regulation, as it were, or do you need guidelines? And I like what you talked about, a handbook, because when I was starting out 15 years ago, we didn't know what the government needs of us when it talk to CBK, they tell you we also don't know. So then what happens? So I think putting it out there, what do we need really?
Good question. Over to, or do we get a few more questions in? Okay, can answer that.
Let's take this one and then we can,
Yeah,
we can come back.
I think at this stage, probably policy is probably the priority. Again, there's been that sense of we need a national policy, something that does provide some guidelines as to how is the sector going to be developed. Regulation, I guess, can be tweaked depending on exactly what you're regulating for. There's already an overabundance of that, as it is right now. Kenyans are struggling with the Data Protection Act, and what exactly does that mean? So you probably don't need too many prescriptive rules around the sector. I think to start with, and we've seen it in with the other markets, it's largely policy-led in terms of how the framework works, even in the UK. So if you get your policy right, I think a lot of the issues that even regulators may be concerned about would be resolved through that.
I'll add to Joseph's comments. I mean, the first thing is be careful what you wish for, because the FCA handbook can be quite hard in itself to navigate. But you're right, it does provide some clarity. I think the other thing to say is that people find it very hard to define what they mean by fintech, right? So one of the hardest things, and it's not enshrined in legislation in most parts of the world, is what is a fintech business? Is it a company that's just providing financial technology, which to my view, it sits outside the regulatory perimeter, so it's providing technology solutions to regulated entities who themselves are then responsible for ensuring that, to my point previously, everyone in their supply chain meets their standards, and they then have a direct accountability responsibility to the regulators to ensure they're meeting those regulatory standards. So I think that's kind of the first thing to say, and being very clear around how you do and don't do that. But once, as I say, you come into the traditional concept of providing regulated activities, that's where, to an extent, I don't think what we're going to see here, and probably in other markets, is a standalone set of fintech regulation, right? It's always going to be a bolt-on to what's there in existing ways. We said, it's very hard, and most regulation is technology neutral, and it has to be by its nature, because you can't legislate for what's going to happen in 2-3 years' time. Lord knows what. I mean, maybe we'll do that this afternoon this evening in the bar, come up with an entirely new business model, but they need to be able to respond in an agile way to new products and services coming through. And that, as a result, means that the regulation has to be, to an extent, technology neutral and non-prescriptive. So I think that's probably where we're going to end up seeing is continued regulation. Spoke about educating regulators, making sure they understand the business models, they can understand the risks that are associated with it, that's a right-sized model that's proportionate with the risks, complexity of that business. So, and Joe made that point earlier. So I think that's the right way of doing it, and obviously one which can quickly adapt to these new models and products as they come through the market, and is not finding an easy way either, so that business cannot find they're regulated, which is a challenge, or they're finding a way of circumventing it such that you create risk in the market.
Just 2 points. One is in regard to collaboration. Ideally, you see that there are a number of regulators that are in place, and what really the regulators require us to do is to closely collaborate. And I think there's a working group on collaboration, particularly on innovation and fintech issues. The second thing is SupTech. Most of the time, SupTech, RegTech with the regulators is something that is still lacking, and you'll get that reporting becomes quite cumbersome, particularly for the industry players, given that now you have to really comply with a number of regulators. That means that you'll be sending different data sets. Maybe some data sets might be the same, but now you'll still have to send it to that particular regulator. So I think regulators need to think about SupTech that would kind of converge and ensure that these particular companies that they are having an oversight on have a system that will be able to harness that data for the purposes of properly regulating or supervising the sector. So I think there's need for regulators across board to kind of improve on their SupTech and RegTech issues going forward to solve some of the challenges that we've mentioned.
So I guess that's all we have time for today. Thank you so much for this discussion. And the audience, thank you for surviving our policy discussion after lunch. Well done.
Where's everybody else? Many thanks. Many thanks to all for that excellent session on policy. And just to mention about the report, hard copies are currently being printed, but you can access the full report by scanning the QR code on the back of the two-pager, which has been distributed during lunch. And for those joining online, visit TheCityUK.com, where it will appear on our homepage. So next up, we have a session covering funding for an investment for Kenyan FinTechs. So to introduce the panel I have here with me, immediately to my left and stage right, Chris Allen, co-chair of the funding workstream, general counsel for corporate, commercial and institutional banking, and general counsel Europe and Americas at Standard Chartered Bank. Chris has worked also as a managing director in the past in group regulatory counsel at Barclays, and he's regularly appeared before and advised many appointees of the US president in the administration of Barack Obama, and has appeared in over 50 times before the US Senate and House of Representatives. So welcome, Chris. Kevin, we'll go Kevin next. Kevin is also the co-chair of the funding workstream for this project. And he's also the CEO and co-founder of Alternative Circle, a digital lending and solutions company, and of course is also the chairman at the Digital Lenders Association of Kenya. Welcome, Kevin. We also have on the panel today Brian Dempsey, who's the CEO of Power Financial Wellness Incorporated. Power is a platform dedicated to providing holistic financial services to working individuals in Kenya and across sub-Saharan Africa. So welcome to Brian. And finally, Michael Mbaka is with us. He's the Senior Innovation Specialist at FSD Kenya, and he is involved in developing financial and non-financial innovations for the real economy, with a focus on agricultural innovations, including managing agriculture risks, health education, and informal workers in diverse sectors. So welcome, Michael. So I think where we ought to start is just a general question, and if you don't mind, I will put this one first to Brian, and that is, we have had, I guess, what would be to your mind the 2 or 3 key challenges to funding facing fintechs in Kenya?
Thanks, and I'm actually in the midst of fundraising myself. It's quite a lot of work, for sure, and I probably speak for a lot of other fintech founders, but it feels like it's an unknown oftentimes. So I'll talk to a lot of individuals who aren't in the room here, and it's like, who do I talk to? Where do I find them? How do I meet them? And how do I get FaceTime? That's sort of the first step. Not everyone can sit in this room and be in the audience with the central bank governor or other banks or investors or influencers in this market. And so what I've noticed is a lot of fintechs coming together as well. As much as there's a growing investor scene in Africa, I think 2021, from what I've heard, is over 800 investors invested in fintechs across the continent, and most of those on the equity side. So there's a huge number, but how do you access that list? How do you get to know them? And how can you work together with other fintechs or startups to sort of promote one another and work together? So one is just access to who. The second is there's a lot that goes into just creating your company. and understanding the structure that you need to set up to get investors on. So I continue to spend a lot of time understanding, okay, I certainly had to register in Kenya when I started. But once I started talking to outside investors, I had to incorporate either in Mauritius or the UK or the US, which meant additional legal fees, navigating different environments that I certainly have no experience in, all just to satisfy sort of an investor discussion, but actually takes up an enormous amount of administrative work, understanding the tax laws, transfer pricing policies between entities, maybe hiring people in different locales. So we've got engineers from India to Eastern Europe to here in Kenya to the US. And so much goes into the admin. And on top of that, as a fintech, we partner up with banks and other regulated entities. And so got to get AML policies in place and KYC policies in place and data privacy policies and understand the complexities just here in Kenya, but we're expanding. We've got partnerships now in 9 countries, and each one is different. So I think access to investors is the starting point. But second to that, a lot of investors want to see your data room and understand how you've structured, and they'll go through that in detail. And it'd be great if there was a sort of framework or almost like a toolkit that people could work from to avoid all of us learning the same things over and over again. And then third is you got to show traction. So every investor wants to see traction. For us, we had to raise money to get the people to build the product, to get to the traction, to raise the money. And so you're constantly like sort of scrapping. And part of that is also convincing regulated entities to partner with you, to give you that chance, but then working with them to get through the regulatory hurdles that exist as well. And sometimes those can go for quite a lengthy period of time. We've been lucky. We participated with the Insurance Regulatory Authority and the BIMA Lab. And we're now engaging with capital markets. And so there is those frameworks, but it takes time to navigate. And so the time lag between building that traction, getting your partnerships, making sure you get through the regulatory hurdles, and making sure there's enough runway to get to that point to now get the traction you need to raise. So there's a lot that goes into it, but I think those would be the 3.
Great. Does anybody want to come in on any of those points in particular? I might bring in Michael. I know that FSD Kenya has done a lot of research on some of the barriers and obstacles to funding. Is there anything that you would like to come into on any of that, or any additional points on? Oh, and Chris wants to come in too after you.
Thank you.
Yeah, so maybe I would add one area that is it's closely tied to what Brian is mentioning on proof of concept. And most of the fintechs, they need to, for them to prove the concept, they need the human capital that is required to develop the models that they are proving. And usually these is actually, would say, specialized skills that are needed in this area. And what we've observed is that the fintechs that have been able to onboard the right skill sets at the onset tend to perform much better. But this is an egg and chicken scenario, because you need resources to be able to attract the right type of skill sets, which they are not cheap. So it's an issue of affordability. I think the issue of availability in Kenya, I think, is not much of a big challenge, but it's more of an issue of affording the right type of people to engage in the various aspect of the business. I think one of the speakers in the morning session mentioned is not about coding. It's beyond coding to set up a business. So you see things like besides this, like the chief technology officers, there's the operation side, there's a business modeling side, there's a finance bit. You just even cracking what's your business model besides the platform side. Yeah, so I think I would add that as one of the other major impediment, which I think is time to
resources also.
Great. Chris, you wanted to come in?
Sure, thanks. I was going to save a couple of the comments I'm about to make until later, but Brian's remarks prompted me to speak now about a few points from a banking point of view, which I think are really quite relevant to this debate. The first is, if I'm candid about it, I think that there is a bit of a challenge amongst some of the banks that they don't necessarily understand the sector well enough. They don't necessarily have the internal risk analytics. They don't necessarily have the internal governance frameworks that are appropriate for the fintech market, and particularly the SME fintech market. I know within my own organization, we actually put a bit of a hold on some of our financing in this space. And it wasn't because of a lack of medium to longer term interest, nor was it because of a lack of realization that actually this is a very important sector. If you can call it a single sector, it's actually multiple sectors, but it's a very important area in terms of wider economic significance. And also significance to us as a financial institution. But did we have the right credit risk analytics, understanding of the AML network, etc., to be able to kind of push forward in scale? The answer was no, not really. And I think a couple of the points that were relevant to that are to bear in mind that some of that is internal. Some of that is about, is the institution as an inherently relatively conservative type of institution got the speed and agility to be able to adjust its frameworks to be fit for purpose for this segment in a time kind of sensitive manner. But the second point is external. My organization is regulated by over 200 regulators around the world in over 70 markets, but it's, as the previous panel highlighted, multiple regulators in many of those jurisdictions. And there are expectations which are entirely legitimate, at least to a point, that are expressed by those regulators around, do you know where you're deploying your capital? Do you know where you're exposing yourself as a financial institution to potential risk? Now, those things are not insoluble. They're not reasons why you shouldn't push forward, but they are real world practical challenges. I am pleased to say that the kind of internal constraints around lending into the fintech space have just been eased within my organization. I think that's important. I think it's absolutely right. But I do think there is then a related secondary problem, which is particular to small startup entities in the fintech space, as opposed to, for example, some of the big techs, which is this vicious circle around scale, profitability, and so on and so forth. So you lend money to a small, medium-sized enterprise in the fintech space. Let's say you've got over those hurdles around understanding the risk analytics and so on and so forth. The amount of money involved is in most cases going to be relatively small, at least for a global GSIB. In the scheme of things, be quite small amounts of money. So is the concern that the bank would have about systemic risk, about its balance sheet capacity to support the investment? No, not really. It's not likely to be that. But there are other issues to do with internal policies and procedures around the return hurdles you need to be able to meet in order to justify the kind of the business case of investing in certain businesses. And there the scale question becomes a bit of a vicious circle, because the amount of cost involved from an AML, client diligence, et cetera, point of view, which the previous panel touched upon, I think, really, really clearly, actually generates a problem of a kind of a certain return hurdle. Unless you can sort of look at a business and understand that the financing of that business is likely to generate a return in excess of X, it becomes quite a challenging proposition just in terms of the kind of the core economics. And that is a very, very difficult challenge for startup entities that don't have the history of P&L, don't have the scale to be able to sort of say, this is confident, this is what our business model looks like, and this is what it means in terms of the risk reward of that relationship with the bank. So I appreciate I'm articulating here a bunch of problems rather than solutions, but they are just kind of real world observations that I think are central to how we kind of break through some of those points that Brian touched upon before. Thanks.
Thank you, Chris. And immediately before I started at TheCityUK, I was in Standard Chartered's global financial crime compliance team. So a lot of that stuff very well resonates with me personally. Kevin, I'm going to bring you in here. During the discussions of our work stream, one of the things that was brought up as a potential hurdle was, and it's been slightly touched on earlier in the discussion, was a lack of fundraising mentorship. Fledgling fintechs quite often don't know where to start. Is this something that that resonates with you and your members?
Thank you very much for that. So there's two problems we identified during the work stream, which is a lot of times the fintech founders do not understand the language required to talk to an investor. What does that mean? Monthly recurring revenue, average revenue per user. Those are the metrics that commercial investors are looking at most of the time. And what you find is most founders are focusing on telling the story and the impact of their solution rather than telling the story of the commercial viability of their projects. The solution there is a combination of things. It's one, educating investors, what do you call them, the founders themselves, because a lot of times, as I said earlier, do not come from that finance background. What they do understand is a P&L. They do understand what traction looks like, but they need to learn how to communicate that traction in an effective way. On the flip side, you also have what you call a pattern recognition problem, right? So the way the commercial investors are used to investing, particularly those from foreign investment cycles or local, they see a founder should look a certain way, the business should look a certain way, and then they're not able to see the opportunity some of the time. So those would, I'd say, be the two main challenges.
Can I jump in? Kevin has taught me a lot of what I've learned in the last year on my fundraising journey. And there's two sides, right? There's the equity fundraise and there's debt fundraising. So equity is telling that story, and like I said, there's lots of investors in the space, and it's just trying to get someone really to buy into your vision. And when you're really early stage, that's what it is. They're betting on you as the individual. And so it's important for someone to go in confidently into those discussions, understanding what the investors are looking for and how to tell their story. At the same time, I think it's important people understand the fundamentals of their business. I think with the VC space, we're seeing a lot of excitement and certainly a lot of valuations that are incredibly high. And there's interest in the venture cap space to spin the company as quickly as it can to get to the next fundraise. And so I think it's important also to identify investors who are understanding the market that you're operating in and ready to take that journey with you, and know the hurdles that are going to come and actually can provide network support and guidance and input. So that's really important. And so identifying those investors who aren't just throwing money at you and want you to raise at 3 to 10x the next time. The other side is the debt side. So that's where there's fewer investors. In my experience, out of those 800, I think I counted 40 that would provide debt. And sometimes it's venture debt in US dollar or hard currency denominated at quite expensive rates. And as a young fintech, trying to hedge that and understand is challenging. The other side is if you look towards local banks to provide, say, overdraft facilities if you're in the lending space, so that you can draw down and on lend to your customers. It's expensive, and then the banks are fairly risk averse. They want guarantees on all of it, so they almost want to guarantee they're going to get all their money back. And when you start as a startup, you don't have the collateral, you don't have the traction, and there's very little you can guarantee to that bank. And so finding guarantee facilities, I think, would be very good ways of incentivizing local banks to provide that debt. Maybe some sort of, even like an interest rebate, pay the bank back for successful deals that they've invested in fintechs, or just providing cash collateral as a way of guaranteeing first loss or reducing risk of taking that step. Further to that, could there be flexibility on opening up additional capital as people grow. So I used to work on the banking side. I spent the last 13 years in financial services, and I headed innovation and digital. And we would just allocate to small startups in different countries $10,000. And if you can lend that out and collect it back, we'll increase it. And if there's ways to help banks start programs like that or thinking like that in ways of just experimenting and growing with the startup as they grow, I think it can really open up a lot. So it's both sides, the equity, but finding local support on debt.
Okay. And one of the things that we discussed in the work stream was the potential creation of some sort of fintech investment fund. And we didn't go too far down the path of working out what that might look like. But Kevin, I'm just going to bring you in here. What do you think that might look like in Kenya, and how do you think we might build that type of function?
I was hoping you asked me that question. So when we spoke about this fintech fund, what we did recognize was, if you go to places like the US and look at Apple, for example, the history, the first investor, the first high-risk investor was actually a fund that was set up by the government. It was an innovation fund. You go look at Tesla, same thing. Now, what Brian also mentioned was, when you're starting up a company, particularly in fintech, it's quite cutting edge or bleeding edge. So it's an idea that's untested. So it has a lot of risk that's carried inside it. Now, unless you have access to an angel network that is high net worth, or you worked in finance like some of us, it's very unlikely that you're going to get that initial early stage capital required to at least get that first set of traction to then go to the big boys, the 800 investors that Brian is talking about. And so the fund, the best type of fund for fintech would be one of those that experiments, and I like the word Google uses, moonshot ideas, something that solves a problem that is aligned with a government policy initiative, eradicating, reducing unemployment, and so there's this solution, and putting $20,000, $50,000 into an idea like that, and just seeing how far it goes. You find that most times all you need to do to get the ball rolling is not less than $30,000, and in our context, 3 million shillings is quite a bit of money sometimes. So yeah, I think that's what it looked like. Early stage, small ticket, with the idea of moving up over time to larger tickets.
And if I may just add a couple of remarks to Kevin's comments. I mean, I think from a bank point of view, one of the potential appeals of the fund construct is, well, I guess there are two that come to mind. One is risk diversification in terms of the portfolio investment. So from an institutional point of view, there will be some of those investments that don't work out. That's a given. But when you look at it on a portfolio basis, you'll be able to assess the overall return story and so on, and it starts to look like a different investable proposition. And the second point, I said 2 points, I've actually got 3. The second point is potential for scale. It potentially looks more, although the individual allocation of cash in question for particular businesses and ventures might be quite small, when you're looking at that at a fund level, it potentially becomes quite an interesting proposition for a different profile of investor who might be less interested in the smaller ticket deal itself. I think the third, which is a topic which we didn't really explore so much, but is the potential for blended finance solutions in this space. So that collaboration between public and private sector, whether or not it's concession and non-concession finance, or whether it's all non-concession, but with that partnership and collaboration with the public sector as well. I think that, again, there's quite a lot that can be unlocked in that space.
Yeah, I want to add something about an area that I think is very important for the fund, because in my view, besides even the startups, the fintech, even the established businesses, let's say the big banks, even the Tier 1 banks, often what we found when some of these ideas that have not been tried in the market For instance, let's say like the digital lending that FSD participated in I would say the first digital lending product where we put a risk sharing as well as a tier for the skill sets that's what needed. And you find that if we have the fund that specifically looks at investments without a chunk of it allowing test and learning, and as you're saying, without expectation of any return, because what we found the failure rate in most of not the businesses, the innovations within the business, because a business could have tried 20, 30 innovations that maybe 2 or 3, because it's test and learn, and most of the time how they started is not how the businesses are at the moment. They have taken a different shift. So I think I see a big role of the public where the blending comes. The part of the public finance of it comes to allow this the test and learning, but as well as something we've talked a lot about, the risk incentives. Yeah, some of the risk I think need to be bought off from the market through such a fund, which could be a blended fund, and I see a big role of the public part of it.
Excellent, thank you. Oh, of course.
And I think one of the key opportunities would be, the incentives NIFCA, for example, combined with a fund that could enable a fund like this to be, just add to the points of the public-private partnership. That combined with tax incentives would make, this kind of investments attractive in the long run.
One other point. I mentioned the banks on the debt side, but there's also the capital markets potential. And I've come across a few groups of high net worth individuals who are willing to put capital at risk, but they also don't know what they're getting into or how to do a due diligence. Or it'd be very interesting to combine and create like a formal, could be like commercial paper that's issued that just is open to the public to contribute into. It's certainly high risk, but it could be contributed and invested in vetted fintechs and startups that are operating within Kenya. I think that would be really interesting, and also get public participation and networks involved.
Excellent, thank you. Plenty of ideas there, right, for more discussion and further development. But at this point, I will invite anybody from the audience who wishes to pose any questions. I did promise to my colleague Charlie that the session that I was moderating would finish on time. So please, yes.
Thank you. Anyone looking at the financing of fintechs across the globe would appreciate that India, South America attracts more money than Africa as a whole. And when I look at the Kariva report written in UK, there is one issue that I have not heard as addressed: the skills, the job skills that would attract persons to want to bring money here. And I want to believe that India is attracting it because of the job skills. So beyond everything else, have you addressed, and I am looking at this report to see whether we are looking at the capacity or the job skills that are generated in a particular market. And of course, in Africa, we know the places where this money is going. It's basically going to 4 countries. It's going to Nigeria, Egypt, South Africa, and Kenya. And you may ask yourself, why is it dry in other markets? I heard you talk about Rwanda and the sandboxes, but my research on those sandboxes is that I don't think many have mothered anything, except for them being on record. I don't know anybody who has really been able to mother anything. So it's a question of being theoretical and being practical. So sitting there, we want to attract global money. And if you ask me, one of the reasons why we probably are not attracting good money is our environment and some of the pronouncements we make may they be public? When you hear M-Pesa is going to have price controls, what do you think that is doing to the rest of the world? I mean, the environment, the skill set, and the entrepreneurship, the innovations, I think this is what are attractive, and money will come where you have those type of things. So may you address the question of job skills that attract the money? I would just like to stop there. Thank you.
Do you want to say that, Kevin?
I alluded to it earlier. I think one of the key advantages places like Kenya has is we've got 15 years of fintech experience brought on by, companies like Safaricom, Equity Bank, and Stanchart Bank, Absa, and what they've done around the fintech ecosystem. In addition to that, you've had several startups that have tried different fintech ideas, and mostly in digital lending. It's gotten so bad that now we are fighting for engineers in this country. And when Microsoft set up the office last year, there was a large hue and cry that they were stealing developers from the startup ecosystem. I thought this is a good problem to have. Now, the challenge here is how do we then funnel more students to study coding, so that they get access to these high-paying jobs. And so that, to answer your question, I think in Kenya, we do have the skill sets, both on the entrepreneurship side and on the operational side. But in addition to that, we are now sort of trying to solve for the problem of how do we get more and more and more engineers in particular to get into these high-paying jobs that we are creating.
Hello, thank you very much. My name is Ezekiel Mashara. So this question is to TheCityUK, and also is back to the comment that was made earlier, where some investors outside don't feel like they understand the ecosystem, they don't understand Africa, they don't understand the market. Is it something you would consider to work with people like the Nairobi International Financial Center to be especially like your due diligence hub point, your AML toolkit support? So essentially, whatever is endorsed by them or supported by them, now the investors can come through that, because I don't see a solution where a startup in Kenya, if they can't even access their own regulators, I don't see them accessing the kind of finance you're talking about. So is that something you can look at, bridging and seeing how you can bring to the market? Thank you very much.
Thank you. And the MOU that we signed with NIFCA, we intend to work with them on a multi-year basis, and the issues that we deal with will largely be dictated by what NIFCA assess to be their priorities. So, but if they were to wish to work in that space, I think that there is an opportunity there for us to share some learnings on those issues. Unless any of my, Chris, you want to come in?
I was just going to say, I think the previous two questions are absolutely spot on, and I agree with them. And obviously, it's not for me to dictate what the agenda is that's set there, but I mean, I think it's a great area for focus, because I think otherwise it's a real kind of hurdle to sort of entry. It's a hurdle to access to that investment. I mean, I'd like to perhaps, given I made some relatively bearish comments in my introductory remarks, I'd like to finish on a positive note, which is that I think there is huge pent-up supply and appetite. It just needs to find its way through the kind of issues that we've been talking about on the panel today to sort of express itself in terms of actual, resulting in actual financing. I know my group chief executive was saying recently that he expects as much as 50% of our revenue over the next 10 years to come from completely new sources, and a digitized economy, a sustainable finance economy are centerpieces within that. And as a related point, we recently committed to as much as $300 billion of financing in the sustainable space, which has a very, very close nexus and relationship with a lot of what we're seeing in the fintech environment. Now, that is a number which is a big headline number and clearly includes the institutional client base as well as the smaller and medium-sized enterprise space. What it speaks to is the capacity and the appetite to be able to finance into new sectors of the economy. And it is appetite, and it is pent-up supply that is absolutely there. So I think if we can unlock some of the kind of the challenges and the issues that have been talked about on the panel today, obviously they're not small issues. They need real thought. They need kind of intelligence and structure around how they're navigated. But behind that, there is, as I say, there is genuine appetite and real capacity to be able to lend.
Very nice to end the session on a positive note. And with that, I'd like to thank my panelists, Chris, Kevin, Brian, and Michael, and just let everybody know that we're now moving to a break. And if everybody could be back in the room in 15 minutes, we can start the final session. Thank you.
Mbaka. Yeah, can you? Nice to see you. The one I need. Because consider maybe some fund other investors who are like luxury restaurants that share. My mind what is that? We have some funds that invested in very many ones that also you can see right now. Yeah, that sector is very well. What we have is these funds that have other funds invested. They are specialized in making the deals. If they're exiting, they know how to sell at what point. So things like that, you just it's a long shot. Yeah, and I think once you start talking, yes, so. Well, yeah, of course. Oscar.
Oh, okay.
Yeah, we'll have a chat. Sure. You have
Perfect. Sounds good. I look forward to that.
Yeah, absolutely.
Okay.
Thanks. We have a lot more to do.
Our country's relationship has long been tech for.
Oh, there we go. That's all right. I just don't want no, fortunately, I am going to. Oh, you are? You're... Yeah. That's okay. You're not doing.
Hi, everybody. Can we please start to take our seats for the final session? Thank you. Thanks, everybody. Please take your seats.
FinTech Forum. I'm very sorry, it's a great pleasure to be able to contribute.
Thank you, everybody, and welcome to the final part of today's event. We're now moving to our second keynote address of the day from the Economic Secretary to the Treasury and City Minister of the UK Government, the Right Honourable John Glenn MP. The Minister was unable to join us today in person, but was kind enough to pre-record a message for us, which is going to play on the screen. And we very much thank him and his office and our colleagues in the UK Government for facilitating this and for supporting our event.
Contribute to the Nairobi FinTech Forum. Contribute to the Nairobi FinTech Forum. I'm very sorry that I can't join you in person, but I did want to take this opportunity to say a few words to you all. Our country's relationship has long been characterized by friendship, partnership, and cooperation. And this event is an example of how financial services has the potential to make that relationship grow closer still. As the Chancellor of the Exchequer mentioned in his Mansion House speech last year, the UK's vision for financial services is of a sector that is global and open to the world. Because as the UK forges its own path outside the European Union, it is our core belief that strong international cooperation should guide and be at the heart of our economic relationships. And this approach means we have placed more importance than ever on building closer links with international financial centres, including Kenya. As you might be aware, today's event follows a number of financial services-related meetings between the UK and Kenya in recent months. Back in January 2020, President Kenyatta and our Prime Minister met in London, where they agreed to elevate the long-standing UK-Kenya relationship to a strategic partnership, including a dedicated focus on promoting mutual prosperity for both our nations. And last July, we welcomed His Excellency the President to London, where he launched the Nairobi International Financial Centre Authority. It was great to see insurer Prudential becoming the first international firm to be based there, and representatives from the centre and the UK's financial services sector signing a memorandum of understanding to deepen collaboration between businesses. And this meeting of the Nairobi FinTech Forum builds on that momentum. And this forum is a great opportunity to showcase the strength of the Kenyan FinTech market to UK investors. More on that later. It's also a chance to discuss how we can enhance the policy and regulatory environment for FinTechs operating in Kenya, as well as to explore how Kenyan FinTechs can scale internationally. But this event isn't just about policy, it's also about people. I know those of you attending today are from a whole range of fields, including FinTech firm founders, policymakers, investors, and other industry representatives. Whatever your background, this forum is going to be a great opportunity to deepen connections between your organizations and ultimately our nations. For my part, I'm very much looking forward to working alongside all of you as we progress this important agenda and promote cross-border FinTech activity between the UK and Kenya. So before I turn to some of the areas where I think our FinTech industries can work together, I'll talk about our experience in the United Kingdom, where the sector is having a hugely positive impact. First, there are the economic benefits. UK FinTech is not only helping to drive the innovation that will ultimately create long-term economic growth, it is also generating jobs and opportunities for people across the whole country right now. Then there are the consumer benefits. Now, in my job, I see firsthand how almost every day new apps or other developments are transforming people's experience of financial services. In fact, 86% of UK consumers now use at least one FinTech service to manage their money or payments or make payments. So where do we in the UK want to go next? Well, while the UK is already a leading FinTech hub representing roughly 11% of the global market share and attracting $11.6 billion of investment last year, we're not complacent and we're not stopping there. We want to nurture the innovation that will drive future growth, and we're doing this in a number of ways. First, we believe that this job of creating the right environment for innovators to flourish isn't just for government, it's for regulators too, and the Financial Conduct Authority's Innovation Hub, which helps businesses to introduce new types of financial products and services to the market, is a great example of how regulators can contribute. The FCA's regulatory Sandbox is another success story in this area. And this was the first initiative in the world to provide a safe place where innovators can try out new ideas in a controlled environment. And a host of jurisdictions around the world have recognized the Sandbox's benefits and since replicated them. Clear evidence that this is an initiative that works. Second, we're helping companies to scale. For some time now, the UK has had a reputation as one of the best places globally to start a fintech. We're now focused on making it one of the best places to grow one too, while creating great jobs, boosting trade, and developing those crucial international partnerships. And third, we're introducing a range of measures to help fintechs to scale, following a major independent review of the sector last year. And these steps include improved regulatory support for new and growing fintechs, initiatives to supercharge commercial support for firms that want to expand internationally, and a new visa stream to attract global talent and boost the fintech workforce. More recently, we've confirmed funding for a new national industry-led fintech body to accelerate the sector's further development throughout the UK and tackle growth barriers. We are committed to working through international fora such as the Global Financial Innovation Network to promote cooperation between financial service regulators across various jurisdictions so we can facilitate that vital increased cross-border activity. Of course, it goes without saying that all our work to promote the UK fintech industry is underpinned by the need to take a joined-up approach to financial innovation. In turn, this means that fintechs of all kinds have clarity about the regulation that they face. And of course, Kenya also has a fast-growing and vibrant fintech sector and is rapidly becoming a regional hub with over 300 startups. From the UK's perspective, we want to increase cross-border fintech activity with Kenya to support the growth of Kenyan FinTechs in the UK and vice versa, and highlight the exciting investment possibilities offered by Kenyan FinTechs, such as this event is doing. Now, I'll touch on this last point some more. As we all know, Kenya has been a cradle for successful financial services innovations for some time. One example is M-Pesa, the mobile money system that celebrates its 15th birthday this month and boasts more than 50 million users in 7 countries. And as I've mentioned, there are hundreds of small firms that are keen to follow M-Pesa's footsteps. So given London's deep capital markets and exciting new fintechs proliferating across Kenya, there's ample opportunities for UK investors here. And those opportunities are becoming increasingly apparent. Indeed, in 2019 alone, some 50 billion shillings were invested in Kenyan startups. As well as highlighting Kenyan investment opportunities, we'd also like to share with you some of the lessons we've learned in the course of other work in other areas, such as sustainable finance. The UK has been doing a lot of work in this space of late. We've just developed a roadmap for greening the financial system, outlining our plans to implement economy-wide climate-related disclosures and a green taxonomy. In addition, we've recently developed significant expertise in raising finance for sustainable economic growth after we issued our first green bonds in the autumn of last year. And we greatly welcome collaboration with the Kenyan government, regulators and industry in all these areas, all of which will be critical to the global transition to net zero. So let me sum up by wishing you all a productive conference and end with a final message to you all. This event is not just testament to the warm relationship between the United Kingdom and Kenya. It's also a clear illustration of the power of financial services to unite people and businesses. And I've got every confidence that together we will turn this shared vision of an even more exciting future for both our nations into reality. Thank you. Asante sana. Hello, everyone. And it's a
Thank you. Finally, we move to the pitching presentations, which is the last segment of today's event. We have 9 exciting pitches to come from some of the best up-and-coming fintechs in Kenya. Each will have 3 minutes to pitch, and we have dozens of people from the UK fintech industry, including potential investors, watching the pitching session online. So I will introduce the first pitcher of this afternoon, which is Peso of Musomi Innovation Limited.
Hello, everyone. How are you? My name is Ken. I'm from Musomi, and our colors have nothing to do with Ukraine, but you'll notice that we have a lot in common regards to the yellow and the blue. I'll go to Musomi. So who is Musomi for now? Musomi, we kind of define Musomi as a fintech play in the edtech space. So basically what we are doing is we're providing a marketplace where everyone that is seeking to transact in regards to the education sector can have access to material, that is affordable, and we can look at issues of authenticity in the whole of the education space. So in a nutshell, how did we get to this place? So 4 gentlemen looked at the issues that have been happening in the education sector every time there's a back to school craze or someone is going back to school. And this has happened from the time I was in school, including those who went to Alliance. This happened to them. And so there was queuing in terms of getting the boxes. There was queuing in terms of getting the books. There was queuing in terms of getting the uniform, and queuing in terms of getting anything that you needed for a school. And the 4 gentlemen, some of them are here, 3 of them are seated there, and I'm standing here, asked themselves the question, how comes that the issues of purchase of educational material is painstakingly similar from the 2000s all the way to date? Why do we still have issues to do with access of material? Why do we still have issues to do with affordability of materials in the education sector? And number 3, why do we have issues to do with counterfeits in the education sector? And so we came up with Musomi. At the touch of a button, you are able to transact and buy a book. You're able to have the book delivered to your place. So picture it this way. You're a CBC parent and you want to get a book on an item for your child. So when you get to the office in the morning, you just buy a book at 8 a.m. And at midday, you have the book delivered to your office or to the school where your child is. And so there's a whole convenience around the transactions. And everything we're doing is cashless. Another thing we're looking at is affordability, because we are not incurring most overhead costs as bookstores. So we are able to pass over the benefits to the person who's buying. We promise everyone that our product is as cheap as the bookstore where you buy your products. The third thing we promise everyone is vendor systems appraisal. So everyone in the platform, we're building an ecosystem. So we don't have counterfeits on the platform. Now, the team is here, close to 10 years experience or over 10 years experience in business development, the tech space, logistics, and customer management. Basically, the traction so far we set up this year is that we have 5,000 SKUs on the platform. We have been able to enlist 35 merchants on the platform, including publishers such as Oxford, Longhorn Publishers, Moran Publishers, Kenya Literature Bureau, Story Moja, and among many others. We have partnerships with Kenya Private School Association. And so far, the product roadmap has made us to set up the marketplace, which is available. We have established the e-commerce platform. We are thinking through setting up an AR/VR platform where you can buy the uniform for your child using AR/VR in the next phase of the product. And finally, the space of digital content where you will purchase and acquire digital content online and virtually. So why are we here in a fintech space? Think about it this way. 15 million of Kenyans, or basically a third of Kenyans in this country, or people in this country, go to a school. And you can think through the transactions that these 15 million go through to be able to access an item, sit in a classroom, buy a uniform, and go back home. So all these transactions currently are ungovernable. It's cash transaction. That's why you have queues around bookstores. So we're setting up a system where we'll have cashless transactions and an ecosystem that covers everyone on it.
And so 75% of our revenue will come from sales commissions, and 25% of our revenues will come from the ads. Ladies and gentlemen, the market is big. Based on the estimations by the Ministry of Education, we're looking at 5 billion sterling pounds market, which is roughly 768 billion Kenya shillings. We're looking at a market that we're targeting in the recent scope at 66 million sterling pounds, which is roughly around 10 billion Kenya shillings. So we are inviting you to walk with us through this journey and understand what we can do in the fintech space, in the edtech space. Thank you.
Thank you, Ken. Next up, we have Christine Ketunge Getala of Peso East Africa.
Good afternoon, everyone. Yes. Oh, sorry about that. Yes, I'm Christine Kitale from Peso East Africa. Peso is passionate about the African businessman. This ranges from the lowest vendor who is underserved in the digital space to the mid-level vendor who has probable integration issues, and to the larger corporate who has multi-tier issues. So the solution we are offering is a dynamic payment gateway that's addressing the cost, time, and risk barriers and the interoperability effect of it all. This is coupled with a B2B and a B2C marketplace, because thanks to the Africa Continental Free Trade Area Agreement, we are looking to connect the different merchants within Kenya and across Africa. So we're trying to enable the perfect sale across the industry, whereby you can connect the manufacturer to the retailer, leveraging on data as the key resource to enable data-driven decisions to be made. We've been in existence for the past 2 years. We're working in a $2.5 trillion market, and we believe there will be an 80% of mobile user penetration in Africa by 2025. This is about 1 billion users. So we believe the digital space is the best place to be. So far, we've been able to process 1.59 USD million in our payment gateway, and we're looking to get $7 million to scale across Africa and offer these competitive solutions to benefit merchants. Thank you.
Thank you, Christine. Next up, we have Koech-Kimwatu of Quick.
Thanks. That's Karaoke Gadito. Yeah. So unfortunately, my deck did not get to the computer. There's a few issues. So if you would go to your browser, type bit.ly, your browser or your phone, bit.ly / quick QUIKK - partners. So 10 years ago, M-Pesa was a peer-to-peer platform. They had a really good run, 5 years into the making, and they made lots of impact. It started as a way to pay back loans, send money to each other. Then at the time I was working at Equity Bank, and James Mwangi came to me and said, hey, James Mwangi is the CEO, and said, we have to deposit money from M-Pesa to the bank. At the time, there was nothing like that. There was no API. There was no way to build out a deposit, direct deposit to and from the bank. And that challenge found itself at my desk. I invented the way that things, APIs worked at that time. So after I had built the first API in Africa, then people were able to send money from M-Pesa to banks. And that kind of like began the renaissance of B2B and B2C M-Pesa. And so what we have been able to do over time is I've run a payment gateway. It's been about 10 years now. We've processed well over 5-6 billion shillings. And there's always a gap when it came to fintechs trying to connect. They were eager to come up with the ideas, do things on the ground, but then they would hit the snag of M-Pesa payments, or how do we connect with this bank and that bank? And that's where Quick was born. We are trying to answer the question of how do you, as a fintech founder, reach 1.5 billion users in Africa? You do that through an app, right? And apps need APIs. An API is basically how systems work together to communicate, to build value, to deliver value. And so what we built is a platform that allows fintechs to build products using with embedded services by making it simple to expose and consume and manage those APIs, the very bedrock of technology. So we've been able to, this is a pretty new idea. We launched in September, and since then we've had a really good run. Our GTV, that's gross transaction volume right now, as of February, is about $100,000 from a variety of 4 clients. And we're looking to close the year at about $40,000 in annual revenue, AAR. And we think that we are on the verge of making it easier for companies and fintechs to really run fast. I look at ourselves as the expressway, right? We have lots of roads in Kenya, but we have now the expressway. 15 minutes from James Gishuru all the way to the airport. If you take normal roads, 2 hours, right? And that is the power of what we've built. We want to make it easy for companies to scale. One platform, you plug in and you have M-Pesa, Airtel, Equity Bank, MTN, wherever you want to go, right? And wherever we are, you are there. And we're not like a payment gateway. We're not like Flutterwave or anything. We are below Flutterwave. We are the infrastructure that allows you to power your platforms. And so I analogize it like plumbing, right? We are passionate about pipes. It's dirty, it's boring, it's arduous. Nobody wants to do pipes, but we love pipes. We love gunk. We love that, right? And that's what we want to do, because you don't want to do it, and you don't have the experience. I've been in the game for 10, 15 years just doing this, and you want somebody as strong on your team, handling payments, handling integrations, handling partnerships, handling everything that you don't want to do. So with that said, we are raising an angel round. I loved the funding discussion. I don't know if angels exist. I've been looking for them. And I wanted to ask the question, but I shied off because I'm sure there are a couple of angels here. But we are raising a round, an angel round, about $600,000. That should take us to, building a product. Like not building the product. We already have the product and it's live. Basically proving our model, proving our hypothesis, building out a customer acquisition strategy, and taking us to the next level where we can start looking at outside of Kenya. And that is my pitch. I hope 3 minutes are good. But we are inviting, I loved the talk about one-stop shop. There's a lot of talk about collaboration, a lot of talk about fintechs doing things together, and that's what we're all about. So I'd invite TheCityUK, even FinTech Association, DILAC, everybody who's here to connect with us so that we can be able to channel those resources together to the fintech community that we are serving. Thank you.
Thank you, Karaoke. So our next session is, next pitch is from Mary Wangi of Data Integrated Limited.
Benedita, a bit lower. Good afternoon, everyone. My name is Mary Mwangi. I'm the CEO and co-founder of Data Integrated. We did not get our pitch online. We were a bit late, so apologies for that. A bit about Data Integrated. Data Integrated is a company that we formed back in 2012, and the idea was to digitize SMEs. we have our flagship product in public transport. So the problem that we try to solve for public transport is, I don't know how many of you have used the matatus in Kenya, but you will find that the system sometimes can be a bit fragmented, a bit chaotic. You don't know when your vehicle is coming, which bus to take, wherever you're going, you don't know where the stops are. So what Data Integrated is looking at is to solve the logistics issue, and also the operators in the public transport industry in Kenya. Most of the vehicles are individually owned. They are required by the state to form what they call SACCOs, or organizations that are helping them to build their own. They're like self-help groups, kind of, that come together for savings and credit purposes. So the whole idea is to improve the well-being of the vehicle owners. I think that was what was formed, and that's why we have a lot of the operators in public transport. There's a few of them that are companies. The issue is that they have a lot of vehicles in these organizations. They have a lot of passengers coming through this system, but they were running their systems in a manual way. So everything was in a book or an Excel spreadsheet. They lose a lot of money. It brings a lot of inefficiency in the industry, and more than 40% of their revenue is lost, and a lot of inefficiencies for the passengers that are traveling within the system. So Data Integrated noticed this as a problem, and so we set out to build a solution that will help digitize, aggregate the data, the information coming from all this public transport, to create a system that the public can use to move around the country efficiently. And also that there is visibility in transactions and what is happening within the public transport. So our products are point of sale devices, cards, we put tracking devices, we use IoT devices to help give visibility to what's happening in the industry. So Data Integrated is actually raising money to make sure we have a full digital solution, not just for Kenya, but mainly for the sub-Saharan sector in Africa, because we have realized that this system is almost duplicated in other countries, some better than others, but the challenges still remain. So we are raising $10 million, and we are hoping that currently we will be able to have a revenue of about 25 million in the next 5 years. Currently, we're about 2.3 million in revenue, and that's in USD. So what makes Data Integrated stand out from other competition who are like Swivel, Little, Bupa, QuickBus, Bupas? The thing that makes us stand out is because we build an end-to-end solution for the public transport. We build for the operators, we build for the passengers, we build for the owners, the buses, and most recently also for the government in the implementation of the regulation that is required in the industry. And we have a very young team. We are almost a team of 50 currently, and it is led by myself, Francis, Brian, and Cecilia, who among us, we have over 50 years of experience. Thank you very much.
Thank you, Mary. Next up, Sibi Salim of Tenakata.
Good evening. Apologies again, just like the same story, my slides did not reach in time. So I will take you through my pitch. 85% of MSMEs closed down within the first 3 years of operations. And that is attributed to lack of capital and finance, and lack of business management skills, lack of financial records, lack of financial literacy. So our typical businesses know how to do the day-to-day running, but they don't know how to manage their finances. So my name is Sebi Salim, and I'm the CEO and co-founder of Tenakata. There are over 100 million MSMEs in Africa and around 8 million in Kenya. And according to the World Bank, Africa has a funding gap of 257 billion pounds. I'm using pounds because of our audience in the UK. They often find it difficult to convert, just on a light note. Kenya alone has a funding gap of at least 14 billion pounds. At Tenakata, we are providing capital to the underfunded businesses. And how we are doing this is we have a state-of-art mobile application, which is very, very simple. You capture your day-to-day transactions as a small business. So you have this accounting system. You don't need to go and take high-end. Remember, these are tiny businesses, micro. They do their day-to-day record keeping on the platform. We take them through financial literacy training using their data. And then we provide them access to finance, either through our partners or through the banks or through ourselves, where we provide them with small tickets. One of the key things that we see in our platform is that we have a very powerful AI tool that is able to extract data from M-Pesa, from various other different sources, and publish that and put that in form of an API for anyone who wants to fund these businesses. They have access to that information. And so far, in terms of our traction, we have been able to onboard over 5,000 businesses. That's quite a small number compared to the 8 million that is available around. And we've disbursed over 2,000 loans to these businesses. We've disbursed over 100,000 pounds, again, to use pounds. And so far, we have a default rate of around 10%, working towards bringing that down. So this is data that is available to our partners, to people who can tap into our platform to support. We are an MIT Legatum startup, and we've received a lot of mentorship and support from MIT. We have a great team of around 15 people. Myself, as the CEO, I have 20 years experience in banking. I've been supporting over 500 banks in the continent. Some of my clients who are here, guys who are running my technology and stuff that I've provided them. My co-founder, Mbula Nzuki, she's also an entrepreneur and also has been in the game. She's a legal side and growth for the business. We are raising $3 million for now. And we hope to use that money to grow our customer base to 100,000 customers by the end of this year. These are active clients on the app. I know when you mentioned about some of those words, MRR and the rest. So these are words that are quite difficult for people. But we are looking at least by the end of this year doing 30,000 pounds as our monthly recurring revenues. So thank you all, and excited to be here.
Thank you, Sebi. Next up, we have a presentation from Shubham.
Good evening. I'm so sorry we are also not able to submit our pitch, but again, you can go to our website. It's www.hylo.xyz, hylo.xyz. You can find all the information there. Right. So in 2020, me and my co-founder, we started to study B2C retail market, right? And we find out a lot of pain points for consumer as well as businesses. So one of the important issues what we have find out there is inability to find businesses online within your neighborhood, right? So that's why we created an online platform, a marketplace for the businesses, right? And here we focuses on small and medium-sized businesses. We give them an online digital presence on our platform so that they can showcase their products and services on our platform, and consumer from the nearby neighborhoods, they can find the products from our platform, right? And apart from a marketplace, we also offer an cost efficient and time efficient last mile delivery services as well. And it's not just for the consumer, it's also for the businesses, so that those small businesses can initiate the delivery request from our platform as low as 60 bob through our platform, right? So instead of creating just a simple a marketplace, what we have tried to do is creating an ecosystem, right, where be it a businesses or consumer, they can find they can fulfill their all needs into one platform. So let's say somebody's offering lending to these small businesses, right? So through our platform they can also find lending uh, uh, through our platform, right? So what we are trying to do is provide a complete value chain to businesses and consumers, so that they can find the services and products they require and it can be delivered to their doorstep. Thank you so much.
Thanks, Shubham. And just a reminder to everybody that for those who were too late with their pitch presentations, if they wouldn't mind us circulating them to everyone, we'd be happy to do that after the event. Next up, Kevin Mutiso, OYE.
Good afternoon, everyone. I actually wanted one of my team members to do this speech so that they practice, but they're all on site. So I'll just do it. I don't need the pitch, so I'll just go straight. So, can you hear me? Let me stand here. Yeah. Okay. So we're solving for two problem statements. The first problem statement was 36% of all, and I say all, I mean all traffic road accidents were border related. Less than 2% of these borders had any type of insurance cover. The border ecosystem employs 1.7 million people, and it is projected to get to 10 million by the end of 2030, right? So that's the market opportunity. What is our solution? We designed a financial services supermarket where we've onboarded the customer at a petrol station, and we've asked them to fuel up to 90 liters, and they get free personal accident cover. This personal accident cover gives them 5 benefits. The most important one is a 10,000 shilling hospital cash, which basically means if they get hurt, go to hospital, get receipts, they get a refund of up to 10,000 shillings. The second most exciting benefit is they get 1,250 shillings per week for temporary disability. And then we give them 25,000 shillings bullet payment for permanent disability and last expense. We've been ideating this idea for the last year, and we actually started by going to the IRA Bima Lab, where Elias was our captain, for lack of a better word, and we met our insurance partner, a company in the UK, and they gave us a solution for underwriting, and then they came to Kenya and got a partnership here, and that's our insurance partner. We've also partnered with 3 major petrol stations. We've partnered with Total Kenya, we've partnered with Delta, and we've partnered with Petro City. We launched on February 24th, 2022, ironically the same day the Ukraine-Russia war began. And we now have over 2,600 borders on our platform, and we have over 50. We've got about 50. We're just about to get to that 90-liter threshold, and the top 500 have at least 30 liters fueled from that day. What is our ask? We've recently raised our angel round. We raised about $310,000 from American and local investors, and we shall be going back to market for a seed round to scale to the rest of Kenya. We have enough capital to scale into Nairobi, and we expect to be at 100,000 borders by the end of Q2. Thank you very much.
Thank you, Kevin. Next up, we have Alan Mukui of Be Free.
So my presentation did make it. Thank you, Ken, for bringing it up. I did actually go to Alliance, Hall 10, Wilberforce. Yeah, but let me get into it. So let's face it, the lending business is actually a collection business. It's easy to give money. It's easy to sell money. The challenge is how do you get it back? And that's where BeFree comes in. So essentially, BeFree, we are building the largest, Africa's largest ethical debt collection business. So our problem statement is simple. Lenders, be it banks, be it SACCOs, be it fintechs, need to collect on the debts they've given. They struggle largely with this. And whenever they outsource it, there are usually challenges. I'm sure if you're in the Kenyan market, you've had the stories, people being threatened with witchcraft and all manner of things. And we actively and passionately want to stop that. So essentially our business is solving for three things. One, how do we make debt collections efficient? Number two, how do we scale that model? Number three, how do we make it user friendly? So at the core of our business is making sure that the debt collection experience at the end of the day to the borrower who is the client is human centered and treats them as if they are human beings. So we found that there are three ways that debt collection happens. One is you have your collection team, so you'll see that it can be efficient. It's quite user friendly because these are your customers, but then it's not scalable. So when you're lending $100,000, it's easy. When you hit $5 million, you'll struggle. When you hit $10 million, you'll now really, really struggle. Yeah. So how are we doing it? So essentially we combine several technological elements, of course, with human call center agents to be able to follow up this debt. As I said, number one, the first thing we do is that we make sure that the experience for the borrower is good, because 9 times out of 10, the borrowers are willing to pay. What has happened, and we've seen it through Corona, is that they may not in a position to pay right now. We work with the lenders to make sure that even if the borrower is not able to pay now, we ensure that we are getting those promises to pay, we follow up on those commitments, and we make sure that the payments do actually come through. So we've built out a system called Gen, and Gen is our sort of machine learning system. Gen is able to do robocalls, Gen is able to engage with customers, and the goal for BeFree is to be able to build a conversational AI that is so good that you as the borrower cannot tell the difference on whether you're talking to a human being or you're talking to a bot. So that collection process sort of splits into three main buckets. So we have a self-service platform that we have been working from that is live in our Nigeria market and will soon be live in Kenya. So this is essentially where a borrower, any borrower, can see can put in all their debts with all the different lenders they have, and our system will help them manage all those debts and remind them on when to pay down those debts. Number two, of course, is AI collections, and I mentioned, and number three is the human-centered collection. So we've integrated, with the WhatsApp API, Telegram. We send out emails, we send out SMSs, and we also make phone calls. At the core of our business, which is what I'm talking about, is the BeFree constitution. So unlike other debt collectors, number one, we feel that it is very important to express to the customer that debt is not a crime. Yeah, you are in debt, you may be in default. Let us help you get out of it, as opposed to, badgering them to repay. And that sort of then informs our ethos across multiple different spheres. I won't go into each of them because we only have 3 minutes and Scott is looking at me. So at BeFree, we are taking your credit collection to the next generation. So we are really working with, we call our clients our partners, the lenders, to make sure that we drive as much technological use, as much use of data analytics and reporting, to make sure that the collection process is made as efficient as possible. That's our team. Our founder Julian and Moses and Chooks have worked in fintechs, which is also a big differentiator for us. We have tried to build a team of people who have actually also worked in lending, who intimately understand the customer and so can provide quite a bit of insight when it comes to the credit collection process. That's a basic nice slide of some of our clients in Kenya and Nigeria. And commercial structure is basically 100% fee-based. If we don't collect anything, you don't pay us anything. Yeah. Thank you.
Thank you, Alan. And last but not least, Naruya Kamau with Tello. Yeah, just.
Thank you, Scott. It's Ngaruya Kamau. Ngaruya Kamau. That's with my mother tongue. So. As you've heard, I'm Ngaruya Kamau. One of the things I want to point out is that we stumbled upon the solution of fintech and IoT. We were solving a problem, and I'll show you which problem we were solving and what are the possibilities of our technology. Now, we're Tello, and we believe in this, in the power of simplicity, not the word, action, action. So Tello is an IoT fintech startup, and our purpose is to simplify modern life using integrating existing technology. What was our problem? In Kenya, when people buy prepaid power, you buy it with M-Pesa and you send a 20-digit code, which you have to input in something like that, which is called the customer interface unit. Physically, yeah? And that's quite painful if it has been installed downstairs and you live upstairs. Yeah? So what were we solving? We needed to actually be able to convert that to a smart meter without changing that infrastructure. Essentially, we were creating what's called a customer product, direct to customer, not direct to KPLC, to the customer. And what we did is that we created an IoT chip that goes into the customer interface unit there, and another mode that goes to the socket. This is the magic that combines a lot of infrastructure when it comes to payment and efficiencies within a house. So we have an app that exists, a USSD, and an app which will be launched by the end of this month. So, as I said, this is the magic, network as a service. And when you talk about a network by a service, it's a network which is being built by every homestead. The minute you connect that mode to your socket, immediately you have an address. That's the biggest issue with every logistic thing in Kenya. When you have to do a payment, it has to be delivered, the guy has to call you. Explain where I'm delivering this. It's always a sentence or a paragraph. Yeah. But with this, with the Tello app, we just open the address and it will ping to the person who's delivering using IoT. And there's endless possibility to this tech. That is what we're talking about. So this is addressing 7.6 million homes in Kenya are on the national grid. Out of those which we want to solve, 6.6 million meters have been installed to KPL in homes. Payments. At every convenience story, there's always payment as the last story. And that's how we combine that. And one of the things we've realized because of this mode, that connected home, we can do quite a lot. And one of the big ideas within Tello is deconstructing one variable that causes the task of going to buy stuff at the shop, and it's called weight. It's called weight. Your salt is going down, your oil is going down. It's the weight. If you can be able to transmit weight to a certain level, you should be able to automate all those tasks with Tellobot. Your health, car insurance, paid per kilometer. Because it's a network of each home connected and what is called a mesh IoT network, when you install these hardwares to cars, you can actually measure how this person is driving. and their insurance can be based on how they're driving, or the miles or kilometers. So in IoT, we talk about messages that are being sent out. That's the size of the market. Currently, we are talking about 40 million messages are being processed in Kenya through the SIGMOD network and partly Safaricom daily. We envisage with ours, we'll be able to get to 100 million in 3 years and 200 million messages within 5 years. That's the team. I'm the captain of the ship. Second is a CTO who've worked with Coco Hardware. Third is a CMO, Pressy, good experience, more than 8 years in marketing. The most awarded creative director in Kenya based on his age, baby. Our legal officer, and all of these contribute. So we've been able to assemble this team on purely awarding shares. No, everyone does this at their private time. And we've been able to achieve that hardware within 2 years. Thank you. Oh, and we're looking for money for angels. That's the biggest thing. I almost forgot that because being excited. I almost forgot that. We're looking for $2 million to actually manufacture the product and deliver it to more than 1 million homes. Thank you.
Thank you, Naria, and thank you to all of our pitches. I'll leave the last word to close the event with Oscar, but before I do, I just want to say a few thank yous. Firstly, thank you to all of you for joining today's event in person, and for those online, thank you too for showing us your support. Thank you to the workstream co-chairs for your support in making it to the event. To the PwC team for working tirelessly on the research for the report and helping us to secure this venue. Thank you. To Charlie, my colleague at the back there, who's moved mountains to make today work. Thank you. To the British High Commission Nairobi team, thank you for everything, including securing our keynote speakers. And finally, to the project co-chairs, Nick Tolchard, who unfortunately was unable to travel today, but has been very supportive of the project. And finally, to Oscar, thank you to you and your team's support. The City UK very much hope that this project is just the start of a long and fruitful relationship under the MOU. Oscar.
I think before I begin to close the session, I want to say thank you to Scott for, Scott arrived in Kenya yesterday. I think this is your first time in Kenya. And for managing the project with the engagement with the City UK, it's been an intense 2-3 months recently, but we've been working since July last year. We wouldn't really be here if it wasn't for the City UK team, but Scott in particular. So you managed the process. You did a great job at emceeing, and I think you did a sterling job at being brave and pronouncing all those complex Kenyan names. So let's give Scott a hand of applause. The other thing I wanted to say is that I don't know how many of you have been following the discussion around a guy in South Africa that created an SMS process called Please Call Me Back. And he's now, I think he's in to make a few $1 million for that creation. So for a long time, I've been thinking, who created M-Pesa? Who is the one person that created M-Pesa? And Ali gave us the answer today. He said the father of M-Pesa was here. And so I think you're in for a lot of money. If you look at what, there's a okay. So I have the location of where we are going to go for drinks after this, and I'll keep that until the end. Scott told me where it was going to be. So, but I just want to say a couple of things. The NIFC is a new entity, and we're doing our best to really help to catalyze things and really try to build an ecosystem or improve the ecosystem for financial services. But even though the NIFC is one state corporation, it's really an amalgamation of so much work by so many people with so many good ideas. But I don't want to go into that. I think the one thing I'd say is that a lot of the people here listen to what was talked about today. We have taken note, and I think we will do our best to really implement some of the things that have come out of the discussions. I would also echo what Joe Githaiga said earlier, that it takes everyone really to make a difference. When I worked in the UK for a number of years, we'd issue consultation papers and for the financial regulator, and we'd get a lot of responses. And in Kenya, when we do this, we don't get that many responses. So if you want a fintech policy, I think that the best people to draft the fintech policy are the fintech guys. So you've got to spend some time to roll up the sleeves and work with us to develop those policies, and then you'll get something that's fit for purpose. Otherwise, you'll just get something that's given to you, and then that'll be it. So that's just a point that I sort of make quite a lot. But look, we need to know where we're going for drinks, so I'll keep this very short. Thank you to all the speakers that spoke today. A lot of you came in at the last minute, so thank you for that. Thank you to the co-chairs of the working groups, of course, Craig and Elias, who worked very hard on particularly on the policy and regulation side. The report that has been developed is a good report, and I think it'll be really something that I hope can really catalyze discussions going forward. The other co-chairs, Chris, Kevin, and Gillian, who didn't join us, unfortunately, and Ali, who's left. The TheCityUK, a real sort of partnership. They're a body that connects with a lot of entities within the City of London and the business and professional services environment. So it's a really good opportunity for those of us who are engaging with them to connect with the UK Inc., if you like, and have access to know-how and several discussions. So I think it's a really important engagement for everyone. So thank you to Nicola and Nick, who obviously couldn't make it here, and Scott and the team. The FCDO team, always a strong partner in everything that we do, led by Jane, obviously, and Andy, who's left, Hosborn. The PwC team that did a sterling job at putting together the report, engaging with all the stakeholders. I know it's sometimes not easy to deal with some of us stakeholders within the NIFC, but it's a process to get where we want to get to, and I think this is what we are all trying to do together. On the government of Kenya side, there is a lot being done to make a difference. There's a lot being done to change things. You have people that are really working very hard to make a difference. You've got people that have been involved in things like the NIFC for a long time, like Nzomo Mutuku, who's here with us. You've got people from the Office of the President that are very focused on what we're doing. Aaron in the corner there, putting his head down, ducking. The EAVCA that have really helped us in terms of engaging investors. Of course, the central bank, Governor Njoroge, and all the other regulators, IRA that was here earlier, our bosses, the National Treasury. I hope they are listening in, so we make sure that they know we've said that. Some of the real partners that we have locally as well, FSD Kenya, Tamara and the team have been exceptionally helpful, not just to NIFCA, but to the government of Kenya in so many engagements. FSD Africa as well, who are a critical partner. The banks that we've been working with and getting ideas from them. So we talk about fintechs, but the banks are also playing their part in this, ABSA and others. The NEFCA team, who have been really good at what they do, working very hard. So thank you to the team for that. All the fintechs in the room, it's really brave of you to be up here and to pitch. And so we hope that this can be the start of something that can really morph into something beneficial, not just for your businesses, but for all the people in Kenya that depend on you for the growth. And so I think the last thing is the location of the drinks, and that is in the floor. So thank you for that. Sorry, the 7th floor. 7th floor. That's where we'll be having the drinks. Okay, so that's it. I think we can close it. Thanks, Scott. Cheers.
That's it. See you on the 7th floor.
I'm not going to join for drinks. I've got a meeting to join now. But thank you so much.
Thank you for coming. And I'm sure we'll.
I think I'm going to try and make it down for April. So we'll see.
That'd be good.
All right. Thanks
Thanks
again.
for coming.
Bye.
Quick photo. We do it. Where? Here. I haven't got my. Which one? Oh, we pull this. We pull
Oh, what are we doing? Oh, putting them all together.
Yeah, that one now would work. It's dropping. Yeah, where is the photographer? This will be a proof that you've done some work.
The trouble is you've asked Kevin to do the
Yes.